Hey everyone, welcome to another course. Hey everyone, welcome to another course of 2020 mentorship, and I hope the previous classes was exciting. Today we're going to talk about false trend lines and break and head and shoulders. We are going to talk about the things that are going to make us see this strategy totally different as the retail traders see them, right? So all these informations out here are the informations of a retail mindset. All this information you're seeing over here are the information of a retail mindset. What are written in the books, what they are placed for you out there so that you follow and fall into the trap, and the banks are gonna hit stop loss and take your money out of your equity in your trading account, and then they get rich, right? So we're gonna talk about false trend lines. So we have diagonal trend line support. Diagonal trend line support is based off of lower lows, like lower lows and lower high. When you're in the bearish market, you see the market doing the lower lows and the lower high. Regarding the retail traders mindset, that's what they see. The market appears to have imaginary lines. It seems to repel price higher. So you see the market, once it goes to a specific level below, you see a bounce from there and it goes back up. So the retail trader tend to draw an imaginary, what they call imaginary line, thinking that's where the support is found and that's where it's bouncing off of that. So that's the retail mindset. Retail trader will extend these imaginary lines into the future and attribute support theories to this. You see, that's what I was trying to say above. Now, when price hit the diagonal line connected to higher lows, retail traders will buy that, thinking that the market is gonna go all the way up. Diagonal trend line resistance. So everything I've just said above is the reverse of diagonal trend line resistance, right? The market begins to make lower lows and lower highs. The market appears to have an imaginary diagonal lines. It seems to revert price lower from there. Retail traders extend the imaginary lines into the future and attribute resistance theories to that. When price hit the extended imaginary lines connecting to the lower highs, sell it. That's what retail traders do. I bet you that's what retail traders they do. Now we're gonna go into the charts. Let me show you what I mean by that, right? Yeah, so this is the head and shoulder pattern that retail traders will base off their trading off of this, right? This is the left shoulder, this is the right head, and this is the right shoulder. This is they mostly take off these trades in a bearish market, taking a sell opportunity on the right shoulder most of the times. This and their targets are probably uh, go down and continuation keep going down, right? But regarding all of the things we said in the previous chats, yeah, now I just started with a head and shoulder. I think I was supposed to start with a trend line, but nevertheless, I'll come back to the trend lines. We're still going to go to that there. You see these head and shoulders, right? Most of the time, they take off their trades off of this. They say they want to sell the right shoulder as a retail mindset because all the books, that's what they teach you. You want a head and shoulder formation, you wait for the right shoulder and you sell it. But now you see this box over here, this box here, which is in red. You see this box over here, right? We will not sell this, right? If we see this head and shoulder formation, why instead doing what? We are happy because a retail trader mindset will see this as a continuation downward. It's a pullback. This will be a pullback for them. This area will be a pullback for them to keep selling this market to go down. We don't want to be selling this, right? We don't see this head and shoulder formation as something to us, right? So when we see this head and shoulder forming, we're instead happy as institution. We know that this is a trap, right? And we know what's going on. Now, what we're gonna do is we are not going to sell this as a continuation panel for the market to go bearish, right? This box here, we instead see this area as a run in stop, in a run in sell stop. We'll see as a run in sell stop. We'll see this box over here as a run in sell stop to this equal lows over here. I want to be buying this instead, with the head being our upper target, right? Because most of the times you see this head and shoulders, they will form, and when they form, retail trader will expect this to keep going down. Now, what the right shoulder will do 9 times out of 10 is it will come to this neckline. Probably will have a wick over here where these boxes are to take out sell stop and stop runs at these equal lows, and it keeps on going bullish, and the head being the target, right? But now retail traders don't yet understand what phenomena is going on out here, unless they have gone through this video and they're understanding some. Probably you see the sell and you see the market reverse and you hit their stop loss, they'll be like, oh damn, I was in profit, I never took profit. Now that's how it works. You understand? So listen keenly and go into your chart and see these things. This is for a bullish market for retailers, right? This is for a bullish market for retailers. So as a retail, you don't want to be thinking this as a retail perspective, right? But this can be effective if we have this can be effective if it is institutionally sponsored, right? It can be effective if it is institutionally sponsored, which is probably you will have a mitigation block, another block at our left side, which will force this head and shoulder to be valid to continue going down. But if it's not institutionally sponsored, then this is a manipulation to induce traders to go bearish while in fact they want to go bullish, right? So you should take this keenly and not just sell this because the books or anything tell you see a head and shoulder you sell, but make sure that it has something that confirms your strategy and it is institutionally sponsored, or if it's not institutionally sponsored, know that this is manipulation. These are the banks trying to manipulate people to lure you at the wrong side of the market, and they gave up the ghost, and like boom, you see the market reverse all of a sudden and go bullish, right? So if it's not institutionally sponsored, then you don't want to be doing it. You don't want to be selling this head and shoulder formation. But if it's not institutional sponsored, you're happy to see this. And when you see this, what you want to see that you want to be buying this instead of selling as retail traders. You want to be buying this at the box area that I put here. You want to be buying it here, expecting the market to weak off these equal lows, taking out third stops and stop runs of those equal low and go back bullish with the head being your main objective as a buyer, right? And the same thing applies in a bearish market. You will see an inverted head and shoulder formation, right? So you see this, but in the other side, like this. This is for the inverted head and shoulder, right? So you see, basically what happens on the normal head and shoulder happens on the inverted head and shoulder, right? The retail trader will be seeing this as a break in market structure and continuation for the market going bullish. But why us will be seeing this, why us will be seeing this as a why us will be seeing this as a running buy stops and run in chase. I will be seeing this as a running buy stops and the market trying to seek liquidity at the upside before going bearish with our head, what with our inverted head being our bearish objective. So the same thing going on in the bullish market is the same thing you want to be doing in the bearish market. You don't want to fall in the traps of the retail traders that are expecting this market to continue going up. it continue going bullish, right? You're seeing this as a run in the equal highs that are above, taking out buy stop, and you see you want to see the market reverse, and your head should be the reverse target in this case. So with that being said, we're gonna go into the charts and see that what we got there. Like I was saying, if you want to see a head and shoulder to be validated, it needs to be institutionally sponsored, like this head and shoulder, right? This head and shoulder was effective because it was being institutionally sponsored, probably by the prior parts of this area over here. You see now it became a good head and shoulder for sale, and it was institutionally sponsored by an order block prior to that. Because if you take this, put it here, right? So you see the power from where this order block came from, right? It came from the mitigation block over here. So I tell you that if you want to see this head and shoulder pattern being validated as you want to thinking as an institutional, you want to be thinking with the institutional mindset, right? If you want to see this head and shoulder formation being valid, it needs to be institutionally sponsored. You don't need to just go into the market and see head and shoulders. Okay, you want to say, okay, I'm selling these, right? But you see the market reverse on the part, right? You see the market go back bullish and he reverse and he probably hit your stop loss because you were taking the trade based off of just head and shoulder patterns that you saw. So now look at this other one. You see how effective it is. Why? Because the market was off a mitigation block, filling the fair value gap, and now it filled the fair value gap and rejected up a mitigation block, giving us a sell entry over here. If you're a trading institution, you'll be taking a sell even at this point. When you take a sell at this point, you see the market retrace. You can take another sell at this point as a retracement into the market, a retracement as an opportunity through this in this order block to give you another sell. You are not seeing this as a head and shoulder, but a retail trader will still see this as a head and shoulder, and it's still valid for them. And watch this. You see the market do this. It came like this, It came like this. It dropped, it retraced, touching the neckline, touching this neckline. These are the neckline, touching the neckline and drop. Right. So you see how validated this trade was for a classic head and shoulder formation, but which is institutionally sponsored, not like you just took the trade without knowing what you were taking, right? But now look at hmm, look at these other head and shoulders here that are not institutionally sponsored. You understand what I mean? But you need to take trades that are institutionally sponsored. If not, you're gonna get really, really affected, and it will affect your trading. And you're gonna lose money trading like that, and you don't want to be trading like that because you paid for this mentorship to take your trading to the next level. So it's good you respect this, right? Now look at this area. This is an inverted head and shoulder, right? This is an inverted head and shoulder. This is it. Left head, head, left shoulder. This is an inverted head and shoulder, right? And now, what would the retail traders think? Since this is not institutionally sponsored, since this is not institutionally sponsored, they would think this market will still continue going up. But since we know this is not institutionally sponsored, we want to see the market take out this high, right? We want to see the market take out this high, which will be as a run in liquidity for us to see this market reverse, right? And once you see the market do this, once you see the market drop down and goes and take out this area, takes out the stops, the buy stops over here, then you want to be selling this instead of buying. So this is what you were waiting for. After the stop, after you see the market run out the stops, after you see the market run out this buy stop over here, you want to be selling with the 20, I think 20 to 30 pip stop loss ranges, right? Let's say you put a 30 pip or 40 pip stop loss for a downward objective. You put a 40 pip stop loss for 150 pip. You see, risk to reward is 1:3, so it's not that bad, and objective still attained, right? So once you take a trade like that, you see the market reverse all of a sudden. Look at how it went down. The market went down after doing that fake head and shoulder. It went up 160 pips, right? So you see the market came out, took out the buy stops at the previous left legs of the shoulder of the inverted head and shoulder. It took out the buy stop over there and running out the liquidities, and you see the market reverse, right? Not only reverse, it came back up here, gave us another entry and drop, and you see come back up here and drop, came back up here and drop. This is another scenario. This is it going on right here. So I showed you a validated, um, a good, a classic bearish head and shoulder, and a manipulated bullish. No, excuse me, excuse me. I showed you a classic bearish head and shoulder formation on a bearish market, and a manipulated bearish and a manipulated inverted head and shoulder bearish formation. So you see the difference, right? Another person will be taking this inverted head and shoulder as a buy, continuation buy, but you'll be seeing this here as a sell. And here you'll still be seeing this as a sell. Now, if you go to what I was trying to understand now, the differences between those two, and you see how effective they can be in the chart. Same thing goes to the trend line. Look at this. Same thing goes for trend line as we're explaining. Retail trader will be like, okay, this is the imaginary line that they will draw that the market needs to be going up, right? They'll be taking their trade off of this, like it's bounce here, they take it, it bounce here, they take it, it bounce, take it, it bounce, they take it. They will still want to buy here, right? But now, once we see this bounce on this line, we know they have an up objective. So we'll be waiting for that up objective to be attained. Once the up objective is attained, which is institutionally sponsored, we want to be selling this instead of keep on buying it, right? So what retail traders see is this. Retail traders see the market go boom, 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 and they want to see this continue going up, right? But now with the institutional mindset that you have, you are saying this as a trap, as a bullish trap. So you don't want to be buying this over here. You want to be selling it, right? So you want to be as a result, you want to be selling it. You see the market doing what? Respecting the previous fair value gap, which is institutionally sponsored, still respecting our mitigation block, which is at our left over here. Still respecting this mitigation block at our left over here. There you go. Still respecting our mitigation block at our left over there. So once we see that, we want to be selling this with this. Want to be selling this, knowing our mitigation block is over here, and the market just saw this fair value gap. And since it was going up, we're seeing this 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 we're seeing this area as the objective being attained in search of liquidity and a fair value gap at our left. We're seeing that those as the up objective to be filled before we short this, before we sell this, right? And now you see the market drop. After that, the market tanked, like the market dropped so drastically. After that, you see the market, instead of the market of going up, what did they do? They will make it, you put, probably the retail traders will put your stop loss somewhere here. Now they'll be choppy at least on this line a little. This is the imaginary line that is said here. The market begins to make lower lows and lower highs. Retail traders will extend these imaginary lines to the future and attribute resistance theories to this. So you see, retail traders will be extending this line, thinking the market will keep going up. But now, what do we want to see? We as smart money, as we're trying to trade alongside the smart money team, we want to be selling this while the retail trader want to be buying, right? And our down objective will be these previous lows here and here. So you see the market, all of a sudden the market just went choppy over here, and you see it breaks, test this zone, making again another head and shoulder. You see this head and shoulder is institutionally sponsored, and you see how it goes alongside even the break in trend line and the reverse with the trap. Everything is reversed over here and it's clean, right? You see it drops, taking out these lows over here. taking out this loss, this liquidity pulls over here, and now before you see the market doing a continuation, right? So that's everything about these fake patterns, these fake institutional, these fake patterns. You don't want to be trading patterns. You don't want to be trading head and shoulders. You want to be trading uh, things that are institutionally sponsored, right? Like they should be institutionally sponsored. They should give you reason that they want to really go bullish or go bearish before you sell those, right? If not, you don't need to be shorting all of those. You don't need to be selling that, right? You want to be buying it instead. So with that being said, uh, yeah, I think that was that for today, and I hope this teaching was exciting and gave you some understanding why the market usually reverse and why this market makers go contrary to what they write in those books out there they give for you to buy. So do not be fooled. With that being said, see you in the next class, and I wish you good trading.